Hi guys, I just wanted to make this video because it seems to me that there are some misunderstandings around what Unity software is, what AppLovin is, what they do, and you know how to value these companies. So I will be talking about that. Um, when you when you look at what Unity is, obviously you know what Unity is, right? We have talked about it. Everyone knows Unity. You might not know AppLovin, but it's an advertising platform, and they dominate the in-game advertising space. Um, More like, let's say, in-game monetization space. Um, Not just games, obviously. In-app, in-app will be a better term, but mostly they're mostly used in games. Um, so are some people think that it is a good decision to pay AppLovin or hold AppLovin stock at a $160 billion valuation. I'm not saying that it is not, but I respect their opinion. There are many smart people investing in AppLovin, holding AppLovin right now. Um, but in my opinion, investing in Unity software at $12 billion valuation right now is a much smarter decision. Um, why is that? First, when I talk to people, from what I can see, people think that paying 45 times earnings for AppLovin is a good deal. Now, that completely depends on what's going to happen in the future. The businesses are the valuation comes from the discounted cash flows. So as you can guess, future matters the most. Um, Here's the thing. They tend to think that paying AppLovin 40 or 45 times trailing 12 months earnings is a good deal. In my opinion, it is not. Why is that? Simply because, since we have been in a freaking bull market for the past, let's say, 3 or 4 years, people, I believe, have lost their ability to assess valuation and price to earnings because whichever stock you look, unless there are some sort of failings or uncertain software business, they they are probably most likely trading at a valuation higher than 30 times earnings. So when people are in that environment, they tend to believe that AppLovin right now is a good bargain. It is not. It is not. You guys have simply lost your senses. 40 times earnings is a crazy valuation for a company like AppLovin, a company that's already at its, let's say, highest, at its peak in some ways. Obviously, it will hopefully keep growing, but this company has been printing money and their margins are extremely high. There's no room for organic margin expansion anymore beyond them increasing their earnings naturally from making more sales. Um, so yeah, a company like Apple and 80%, 70% net margins, 20% or 15% of it is tax. So they're only spending 15%. Um, 40 times earnings for this company implies that for just, you know, to let you understand what I'm saying, I'm just gonna give you a bit um un unused a bit some an unuseful example. Think of it this way: 40 times earnings mean that if you do not discount, the future earnings, let's assume we do not discount the future earnings, and let's assume that AppLovin does not grow from this position. It's just an assumption. It will take AppLovin 40 years to just pay off itself. And you're not discounting the earnings, you don't have a discount rate, so we do not consider any opportunity cost or anything similar or any risk, right? Just as it is. It takes them 40 years. Obviously, if they can keep increasing their earnings, which I doubt it will be at this rate, but it will be shorter. With that said, it's still a very long amount of time, because for me, I do not know if AppLovin exists in 10 years, just like Unity. I do not know, but you might say, you're just being a bear. You are just being a, I don't know, a pessimistic guy. Um, Here's the thing. I mean, 20 years ago, if you went to somebody and told them that Nokia would literally become obsolete, they would probably tell you the same thing, right? Nokia was the king of the smartphone manufacturers. It was a great business, a large business. Now, some competitor came in many years and then took over them. So same thing could happen to AppLovin or Unity or any other business. But the thing is, AppLovin is in a much fragile, I'm not saying weak, but a fragile spot like Unity, because obviously these are not hardware producers. Um, these are software businesses, but beyond that, this is an advertising business. If a better model or a better advertising business comes, um, I mean, a company like AppLovin, especially AppLovin, will lose a lot, unless obviously the entire industry keeps expanding. That's the one thing with AppLovin. AppLovin is so big, so large, that to keep increasing in value, they need to push the boundaries of the entire industry. Obviously, I think they're trying this in e-commerce. They're trying to move to e-commerce in games, in commerce ads, or in app. I don't know. I think decent amount of financial apps, they do use max mediation, but also there are a lot of apps that use AdMob. So I think I mean, they do have a decent chance, but the thing is they need to keep pushing and pushing and pushing. Now, what's the good thing with e-commerce is that obviously it's a much clearer in terms of targeting, and it's a much it has a higher margin than game advertising, because if the user buys that product, obviously the advertiser makes a lot more money than a user downloading the game. um so there's definitely some positive in that. But with that said, the one thing and the most important thing about this is that they do not have any first party data. They do not have any first party data. So when they asked, the CEO of AppLovin 2 or 3 weeks ago, where do you get the data for e-commerce? He completely avoided the question. He pointed out to some simple in-game data that any ad network has, from MMPs and their SDKs or whatever. What a player plays, how much, for how long they play it, whatever. They completely avoided that question. How do you get the data to target someone who plays a game that has your mediation, that runs on your mediation? How do you show them this, for example, whatever this is? I mean, how do you know that they are interested? because they have been IP tracking, they have been fingerprinting illegally across platforms. Even if it is not illegal, I don't think any other network does it at their scale because they're the only ones pushing e-commerce this much. AdMob does not do it. Meta, I believe, does not do it, at least on iOS. I know the iOS side because I have an iPhone. Applovin is the only advertiser that shows me these e-commerce or similar ads when I go click on a random website on my phone, and I have no idea how they know that I'm on that website. Obviously, um, the short sellers address that, um, cross-platform fingerprinting. If the website that I clicked somehow has their SDK or mediation or whatever in it, they take that and they track my IP address all the way down to the the game. So that's how they do it, and the CEO did not tell that because he cannot. And I'm not sure. I'm not gonna tell you that it's going to be impossible to do. It might be possible. They might keep on doing it, but it's not a safe way. It's not a sustainable way. So again, 40 times earnings, as we talked about 40 years, let's say 20 years, if they double their earnings somehow from here. Um, I mean, it's 20 years. Do you think they will be able to do that for 20 years like this? Live targeting, taking data across different websites and targeting in games? I mean, that's really that sounds quite absurd, doesn't it? So that's my issue with Apple. It's like, and everyone is, you know, avoiding this. Everyone is pretending that this issue does not exist other than short sellers, which is insane. 45 times earnings, $160 billion valuation for AppLovin, an advertising business, you know, obtaining such premium. Again, it might be cyclical as well. I mean, there are many risks, right? Like, what do they even do? They have an advertising model. It's not even that complex. That's the other thing I'm gonna get to, which, they are growing their revenue. Everything looks great for now, but you are taking a lot of risks with investing or holding AppLovin at these valuations. Now, again, I'm gonna get to, since when we have we been, valuing the earnings? I have no idea. I've been in this for I believe 5 or 6 years. I mean, I've been investing for 5 or 6 years, and I cannot tell the last time we have valued the earnings this much. So everyone is like, AppLovin at least has earnings. Unity does not have earnings. Unity is this, Unity is that. So they have given Unity a $12 billion valuation, which is not cheap, considering that they're making $500 million in revenue and they're not profitable yet. I mean, they are profitable if you do not factor in the amortization, but again, they will be GAAP profitable in 3 quarters. So they're still not. I mean, if you look at price to earnings, obviously Unity will be much more expensive than AppLovin for a decent amount of time. But again, that's a very simple way to look at it, and it's not useful. So the question is, since when have we been purely valuing the earnings? And I believe the answer to that is, for the software businesses, we have started valuing purely the earnings after that crash, a few months ago, the SaaS apocalypse. Since then, we have been valuing the earnings and what the company does, but especially the earnings. Um, so a company like Unity Software, which has a very decent moat, very decent product and moat, and a stronghold in mobile advertising and a a very decent roadmap, we do not trust Unity. We do not pay attention to Unity. We completely ignore Unity because they are not profitable and they are a software business, and they are somewhat, for our assumption of terminal value, they're at risk, right? Again, we do not know what's going to happen even next year. So again, just like Nokia, with a much higher risk of becoming obsolete, so we completely avoid Unity, which is totally understandable. There are not many institutional investors in Unity right now. I mean, institutional ownership is very high, but it's not like Applovin where you have a hedge fund hotel. You have some big investors in this, and other than, I believe, Gavin Baker and I think Slide Path Capital, you do not have um, any significant, you know, active hedge fund, actively trading hedge fund. Whereas for Applovin, you have a, a lot of hedge funds, in, you know, trading this thing actively. So again, the question is, since did we value the earnings, purely the earnings? So that's my answer to that. But again, if we stopped doing it, and if we trusted, if the markets saw somewhat that Unity will stay for a longer time, and if they saw that this entire agentic AI thing actually benefits Unity and will not pose any threat to Unity, then I believe obviously the stock would re-rate, but I don't know if that's going to happen. Nobody knows. I have no idea if Unity will keep existing in 10 years. I hope so. Um, but so far, I like what I've seen. Now, let's talk about other things. When people say, oh, look, Applovin has 40 times earnings, and when I point that out, they tell me Unity does not even have priced earnings. Like, what are you talking about, right? Uh, if Applovin is expensive, Unity is uninvestable. Again, that's a very simple way to assess an investment. Um, Unity, Applovin, looking at Applovin as we talked about it, has 80% margins, has been making a lot of money because they have a stronghold in the mediation. They see the auction, they control the auction, they see which ad network bids how much, and they outbid them by 1 cent if whenever they want to. So they do have a decent market share. Now that 80% margin obviously will not hold if they see any, if they face any pressure from the competitors. I'm not saying Unity, but mostly like Meta and AdMob. I mean Google. They are most likely going to um, push to defend their ad networks against Applovin. And I think Meta started to, they have been working to bid on non-IDFA traffic on iOS. So yeah, that 80% margin might not hold. And I think they should reinvest in the business. I mean, they keep buying their own stock at this valuation, which I don't think is a smart thing to do unless you're too sure that you will be fine. For Unity, I mean they're already profitable, but again, if we assume that the amortization will not run off, then Uh, Again, I mean, Vector keeps growing, their broader business keeps growing, so they will be fine. Um, and I will be fine. I have years. I can hold this thing for as much as it takes, as I have been for the past 2 years. Um, and yeah, it is what it is. Now, obviously, you're spending a lot more on research and development compared to Applovin. Why is that? Again, when you look at what Unity does, um, you have a team for every single thing here, maybe even more. So 2D, artificial intelligence, animation, asset management, audio and video, whatever, all these things, all these separate things that constitute a game engine, Unity has a team for them. Um, so obviously they do spend a lot more on research and development. Um, and they do what AppLovin does. They have a mediation, obviously not as big as Max, but they still do have a mediation. But the core of both of their businesses are their advertising model. So they do that. So they do what AppLovin does, plus a game engine that has 70% market share, um, which is a very complex technology and very important technology. Again, you're valuing AppLovin, 12 or 13 times more than this. If you think that is reasonable, so be it. But I don't think so. Again, since when have we been valuing the present earnings this much? I have no idea. But it is what it is. I mean, I'm willing to wait, and hopefully um, things work out for me. But yeah, this was just a short rant. Thank you for listening. See you later.